AMC stock is down a whopping 6% on the day today. About 6.5% to be more precise. Let's talk about what's going on today with AMC stock, guys. It's a rough one. If you're watching this video, if you are an investor in AMC, we have problems. Very big problems, okay? With dilution being one, there's this fear of dilution, which is as potent as dilution itself because it keeps people away. It keeps shorting the stock. If you don't get a commitment to not diluting shareholders, AMC stock will continue to fall. And I know that sucks because AMC has been down 10 out of the past 11 days. You've only had one green day in 11 days. It's been pretty rough, but it's probably not going to get much better from here. Unless you do see more money come back into our markets, and that isn't exactly happening right now. So that's a bit of a problem as well. AMC stock now down 7% at the time of recording this video. Just getting absolutely beaten down, okay? Today is really, really a rough one. And the main reason for that is stress in the economy, okay? At least that's what it seems like to me. If you look at Empire State Manufacturing, this just got destroyed, utterly obliterated. Negative 43.7. The estimate was -5. Like, what in the world is going on with Empire State Manufacturing? Like, what? This is the largest pullback you have seen since 2020, and other than that, you've never seen a pullback like this. You've never seen a -40 reading on Empire State Manufacturing, unless you were, going through a sharp slowdown like you did briefly with the Rona. So that's a little bit of a concern, and it does put more concern on tomorrow's data point that is going to be retail sales. Now, retail sales are expected at 0.4% month over month. If this number comes in weak, let's say 0.2 or 0.1%, stocks are going to get obliterated yet again tomorrow. Because ultimately, it doesn't matter if we get 7 rate cuts or we get no rate cuts, 0 rate cuts in 2024. Stocks will do well as long as the economy does well. So rates and Fed policy, that's really a back burner to how the economy does. That's why all of the focus, all of it, is going to be on the economic data and how the economy is doing. Not just that, but earnings as well. We want to see how earnings are holding up, if earnings are going to come in better than expected, what the situation looks like with the S&P 500, because that could change the valuation for, the markets, right? If we think the markets are trading on an expectation of 11% EPS growth for 2024, let's say somehow it was negative. Let's just say deflation really starts to eke its way in, and the economy gets a little bit worse, maybe, and you're negative on EPS year over year. Well, what's going to happen then? Well, stocks are substantially overvalued, trading where we are right now. So, bit of a problem where we are right now. Now, tomorrow, you're going to get a lot of Fed speakers as well. Fed Barr will speak at 9 o'clock in the morning, Fed Bowman as well at 9 o'clock in the morning, and Fed Woods at 9:15 tomorrow. You're also going to get industrial production month over month, capacity utilization for December, industrial production year over year, manufacturing production month over month, manufacturing production year over year, business inventories month over month, and retail inventories excluding autos month over month. So all of this data will be very important. And again, like I said in the last video, it's all about the direction in which the economy is going. If the economy looks like it's getting worse and going downhill, that's going to be important. Empire State Manufacturing, hopefully that's not a precursor of what we can expect with this data, because if it is, we are in a whole world of trouble, because that was a terrible print. The worst print you could have ever imagined for that came out today. So it's setting a bad taste in investors' mouths heading into tomorrow, retail sales, and the rest of this week. Specifically, why retail sales are so important is because anywhere from 70 to 73% of the economy is based on personal spending, people just spending money buying goods and services. Well, if that retail sales number comes in bad, then it's going to change the estimates for Q4 GDP. Instead of pricing in 2.2% GDP growth, we could price in far less than that if we have a bad number coming out tomorrow. Now, the estimate did not change today as per the New York Empire State Manufacturing Index, because that really doesn't have much to do with GDP itself as just one region and one area. But retail sales as a collective will definitely have an effect on GDP and maybe show that we're heading into recession faster than we thought, or, maybe things are going good. For an example, if we come out with like a negative 3% number for retail sales, the markets are going to panic. The markets are going to sell down just like we've seen today. Okay, and it's going to be a rough one. Now, Treasury yields actually rising today. Treasuries, 10-year Treasuries up about 12 basis points. 2-year Treasuries up about 10.5 basis points today. So that is also putting pressure on our markets. And the 10 and 2-year yield curve, we can actually just go ahead and calculate it right now. 10-year at 4.07%, 2-year at 4.24%. So you're looking at a yield curve for the 10 and the 2 at negative 17 basis points. So uninverting a little bit more even today as well. As you probably know here recently, as the yield curve has been rising and actually uninverting, you have been selling off. And some people believe that is because a recession, is around the corner once you go positive on the yield curve. Now, taking a look at what the markets are currently pricing in for Fed policy coming on March 20th, we're still pricing in a rate cut, but the odds are falling. So yesterday, the odds were 66.1%. Today, they are 62.8%. So, definitely starting to price in less Fed policy slowly but surely. And for the entirety of 2024, we're pricing in less rate cuts as well. Now today, 1, 2, 3, 4, 5, 6 rate cuts are now being priced in. All of last week, you were pricing in 7 rate cuts. Now it's barely pricing in 6 rate cuts. 6 rate cuts priced at 37.5%, and 7 rate cuts at 35%. So definitely that's having an impact on our markets as well here on the day today. Fed Waller is another big story of what happened today. Fed Waller was basically back and forth, saying good things, saying bad things. We talked about exactly what Waller said in the last video, but essentially, a lot of other people are picking up on this as well. Here you can see Nick Timmerhouse says, question to Waller from David Wessel. Why not just stop balance sheet runoff now so you don't have to pussyfoot around and find the appropriate low level of reserves? Waller points to this paper. There's bad optics of paying excessive interest to banks. So, when Nick Timmerhouse is starting to, ask those kind of questions from the Fed, then you're probably closer rather than not to seeing the balance sheet reduction stopping or at least slowing down in a very big way. So I think that's important to point out as well. Now, this is also pretty fascinating. U.S. banks are facing unrealized losses of roughly $685 billion. They are desperately hoping the Federal Reserve will cut rates sooner rather than later. So held to maturity securities right here in blue, it's rough. Now, these securities are about 60% of the total loss. Available for sale securities are about 45% of the loss or so, just rough numbers here. That's really bad. Available for sale securities. Typically, as you can see in most other times throughout history, you actually see both of these do well, right? Held to maturity securities and available for sale securities. So it's been a pretty good bet lately in relative history, right? The last 20, 25 years to park your money in shorter duration treasuries, or even 10-year treasuries for that matter. And then when you need to sell them because you're seeing a lot of redemptions, then you just sell them, collect whatever profit you had on the face value of the bonds, and let people have their redemptions. The problem is now people are trying to, withdraw their money just for normal day-to-day operations for the most part, and banks are having to sell these bonds at massive losses. That's a problem, and that's because the Fed has been raising rates so aggressively. A lot of banks hedged for interest rate risk, but they did not hedge for 5.5% rates. I don't think anyone was expecting that. In all reality, we probably should have been, but that just did not happen. And again, Fed Waller was kind of back and forth today, said some good things, said some bad things, but overall, kind of a net negative though. Now, what also happened today is Waller essentially said that the Fed should start slowing down or stopping the reduction of their balance sheet at some point in 2024. Now, this article from Zero Hedge says it's all over. Powell's Wall Street Journal mouthpiece and JP Morgan confirm imminent end of QT. Like, by imminent, well, potentially the next Fed meeting. This from Real Time Economics says Fed deliberations on slowing the shrinking of its holdings will start as soon as this month's policy meeting and aim to avoid disrupting financial markets. So you're probably going to see this. Now, JP Morgan says as well, it's all over now. QT. He says, we now expect that the FOMC will have the outline of a timeline at the January meeting communicated in mid-February minutes to the meeting. We expect that this plan will be formally agreed to at the mid-March meeting and will be implemented beginning in April. So the reduction of the balance sheet is pretty much over at this moment. If you are a bull, this is something that obviously is going to be good news for you because that's going to be very accommodating to our markets and play in very well to the situation of the Fed cutting rates also. We could be looking at the Fed cutting rates here and stopping their balance sheet runoff very, very soon. This is really because of the reverse repo market that is basically gone at this point. Okay, you went from $2.5 trillion. Remember, we used to talk about this a lot. Now down to about $600 billion. There's a lot less money that banks have at their disposal. Now, with that being said, in regards to AMC specifically, if hedge funds or institutions do come under trouble because maybe AMC stock starts to rally or something along those lines, you could be in for forced liquidations quickly. Okay, like very quickly, because this is just a measure of excess money in the banking system, right? This excess money can go towards, loans, specifically loans. So banks, right? Let me just say it like this. Banks are allowed to loan out money and they are allowed to buy treasuries. When you're thinking about forced share liquidations, what it really is a JP Morgan, for an example, it gave out a $100 million loan to Citadel. Let's just say that. Well, if Citadel comes under trouble and that loan is now a lot riskier, they either have to post a lot more collateral. Remember, if you guys have watched The Big Short, where they had to keep posting collateral because their positions kept getting riskier, or they just have to outright give that money back, see a recall on their loan, which is essentially like getting a margin call, but not exactly the same, right? You don't have to be in a margin kind of situation to see a forced share recall, or forced loan recall would be what it really is. So that would force hedge funds and institutions to start buying back shares of AMC stock. Now, that would be only if AMC stock does rocket higher. Now, a couple ways this could happen. I've been very clear, and I'll say it again, and I'll probably say it again after this video. You need a commitment to not diluting shareholders. If you want big upside, that's where it's going to come from. AMC stock at the time of recording this video, down about 7.5%. It is a rough one, okay? It's been rough for AMC because of this fear that we're going to get more dilution. If that fear were to go away, then I think AMC could have some very favorable upside from here. That's pretty. I mean, that should be well known to everyone out there. But if not, it's just a tough situation to get shorts to cover on their short positions when you have, I mean, dilution coming, right? You wouldn't cover on your short position if you knew dilution was coming, or in other words, if you were long on a stock, you wouldn't sell that stock if you knew your equity was going higher. Essentially, the stock was going higher. You would just hold the stock, right? It's pretty simple. And that's kind of what is going on, but to the opposite. Hedge funds continue to short more and more quantities of AMC stock the longer we don't get a commitment to not diluting shareholders. On top of that, you do have this other aspect. When the Fed does start reducing their balance sheet runoff, that's going to be very stimulative to our markets, and that will probably pull more money back into stocks. And also when the Fed does start to cut rates, that will also be good news for that as well, right? That'll bring more money into stocks, and that'll be good news for AMC stock investors. What's really been going on with AMC, with your average small mid-cap stock, there just hasn't been money coming into our markets. That's been the real problem. Money is gone. Money is going into bonds. Money is going into Magnificent Seven. Money is not going into the Russell 2000 or the Russell 3000 or Russell 1000. Just money's not going in there. Okay, and that's for justifiable reasons, right? The Fed's been raising rates. If we go into recession, you would want to be in Magnificent Seven names. You wouldn't want to be in, small and mid cap stocks. So it's been justifiable. I can't argue with the logic there, but it definitely has not been helping AMC. Now, I could see some way that this could actually all happen at the same time, right? If you do see Fed starting to cut rates, quantitative easing starting to happen, and then you get that commitment from AMC, you could pretty shortly be looking at AMC absolutely rocketing higher from $4 per share. And you got to think about it like this as well. A lot of retail investors have already sold AMC if they were going to sell AMC. So if AMC stock rallies now, all of the shorts that are accumulating some massive positions here are going to get wiped clean pretty quickly. Just imagine if you're shorting at $4.20 per share, AMC stock jumps to $8.40 per share, you already lost 100% on your position. I don't think that's too unfeasible. So any shorts that are buying short positions here, if things turn south for them, you could very shortly be looking at some forced share liquidations. And that is something that I want to keep on your radar. It's obviously not a guarantee. We need to see a couple things happen. I am optimistic, and I think it will. Now, again, to my point, I think AMC stock is hundreds of percent sold short. I don't believe this 9% short interest BS, okay? I think it's BS. I think it's noise. I think it's just demoralizing for a lot of apes out there, right? And I think that's the point of it. I think that's why there's so many short positions that are being covered up on. Obviously, I'm not a financial advisor. I'm not a financial planner. I cannot confirm that. I have no proof of that at all. So when I say it like I know it, that's because I know it. You might not know it. I don't have proof. I go off of faith and confidence and what I've learned over the years of watching AMC. It looks like in no way, shape, or form did short sellers ever cover on their short positions in AMC stock. And the only way the short interest could be 9% if shorts actually did cover, then you've seen a lot of selling from retail investors. And I don't think that's actually happened. I don't think there's been a lot of selling. I don't exactly think there's a lot of buying going on as well at this current moment in time. Now, if you take a look at the short interest free float, the legal numbers, you do have 9.22% short interest, $106 million worth of short positions. Days to cover 1.2, 23.09 million shares currently sold short. Shares out on loan, 17.68 million. Cost to borrow 1.09. Utilization of 29.65 and a short score of 54.25 out of 100. Cost to borrow fees across the board less than 2%, so nothing too exciting over there as well. And if we take a look at the option activity today, definitely more so towards the call side if you're looking at retail investors. Put to call ratio today of 0.38, about 72.5% of the volume to the call side, 27.5% of the volume to the put side. So definitely favoring the call side for retail. Hedge funds and institutions, on the other hand, favoring some bearish trades on AMC. You have seen 15 orders totaling $712,000 today with a positive order value of 0%, which really, that's not surprising. In the entirety of last week, you have seen 43 orders totaling $1.9 million with a positive order value of 6%. Yeah, so it's been pretty rough for AMC for a while now. Now, Stocko tracker data. It looks like you are seeing a little bit of an increase here to option activity today. Calls in the money about 1,200, calls out the money 240,284, puts in the money 102,000, puts out the money 40,000. So definitely lots of option activity here. If you do get a reason to move big this week, then you obviously could. If we are going to get a reason for that, it's probably going to be tomorrow with retail sales data. If you do see a plummeting here, that's going to be very bad news for stocks. If you do see an increase to retail sales, as high as possible is going to be good, right? Retail sales coming in at like 1 or 2% would be very good news. Also, really push back on the narrative of a recession for 2024. So I think that will kind of dictate how we trade, at least for tomorrow, potentially on Thursday as well. Again, lots of Fed speakers, though, over the next couple of days. If any of them say things that are good or bad, that's obviously going to have an effect on things as well. Now, if you take a look here at stock twits and the gauge of these gauges, sentiment and volume for AMC, sentiment is extremely bearish at 6. 1 day ago, it was at 64. So people woke up definitely on the bearish side today, and the message volume is sitting at normal of 47, which that is up from yesterday at 18. So I always want to see message volume good, right? I want to see people extremely bullish as well. But if I were to choose between sentiment or message volume, I would want strong message volume any day. The sentiment can change, and expect it will change based on what's happening on any given day. Now, participation ratio as well, that is also looking pretty good. Normal at 47. The higher, definitely the better as well with this one. You just want activity around AMC, even if the sentiment is bad. Still, activity is going to be better than no activity. And if we look at some of your technical indicators for AMC stock, the RSI at 18.85. I believe this is one of the lowest RSIs that you have ever seen for AMC. Back here, you were at about 18.5. That was in January of 2022. Yeah, so this is the most oversold AMC has ever been, is right now, which is kind of crazy to think about, but it's just been Red Dead Redemption every single freaking day. Red Dead Redemption 2 over here, just clobbered day in and day out. The MACD surprisingly is pretty neutral, actually slightly negative. I expect that will start to curl down in a much larger way over the next coming days. Let me know what you guys think about this information down below in the comment section. Again, my personal opinion, you probably need to get over 10 or 12, potentially $15 per share at this point, just to get some of those forced share liquidations, forced loan recalls that start to play out for AMC stock. But that's just speculation on my part based on how many short positions were probably taken on down here in the sub $5, sub $6 levels. So let me know what you think down below in the comment section. Hit the like button as well as subscribe to the channel. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.